Hi, everyone. I am very excited to be presenting South Africa's first regulated cryptocurrency investment. In order to explain why we made this product and the benefits of this product, I'm going to have to cover some concepts about how traditional investments differ from cryptocurrency investments and the difficulties investors face when dealing with cryptocurrency investments. Now, not to cover ground that Professor Monica Singer has already covered, traditional assets and crypto assets are vastly different. The list is very, very long, but I'm going to focus on the first 2 points of these two lists, the points that are highlighted in bold. The first is trust, and the second is regulations. Something we don't often pay attention to is that even with the simplest of financial products, there's a lot of trust involved. When you make a deposit at a bank, for example, you're trusting that the bank is going to keep your money safe. You're trusting that when you want to go get it, it will be available. You're trusting that if you make a payment, that the bank will actually pay the right party. Compared to the crypto space, where no trust is required. Separately, or secondly, the reason why we're probably willing to trust these traditional institutions is because they are regulated. There's someone that's making sure that there's sufficient capital. There's someone that's making sure that the parties don't misbehave. And finally, the regulator is someone we can go to and complain to, and hopefully they can set things right for us. In the crypto space, not to contradict Professor Angela Tsakowicz, often there is no one providing these checks. And there certainly isn't someone we can go and complain to who will set matters right for us. While being trustless may sound like a good idea, it requires a lot of work. Even if you, as an investor, are comfortable with buying listed shares online, for example, it requires a different skill set to execute trades in the world of cryptocurrencies. Once you manage to execute these trades, taking control of your assets is also a totally different skill set. There's the concept of a private key, which is how a person owns and controls their cryptocurrency. And if this private key is on a computer that crashes, if it's hacked, if someone writes it down and it's destroyed, then there is actually no way to get it back. That's because there is no forgot password link that you can click and everything will be okay. It's estimated that 20% of all Bitcoin ever issued has been lost in this way, which comes to a staggering value of 2.2 trillion Rand. And then there's ongoing risk mitigation. To take the simple example of succession, that when someone dies, ensuring that their heirs actually get their cryptocurrency, this is also not straightforward. And then it involves their heirs also setting up these systems and processes in their lives and upskilling themselves. And then there's an ongoing basis of maintaining your knowledge, skills, systems, and processes. However, there is a benefit to doing all this, is that you then aren't required to trust as many people. There's less trust required, and that results in certainty. Now, a lot of cryptocurrency investments are unregulated or unregulated to the extent of other investments. And this has many advantages. It means that people that produce these cryptocurrency investments can move quickly. They can often do things that are not possible in the traditional space. And this leads to a lot of innovation. However, this innovation comes at a cost. It involves investors doing a lot of research and understanding what these investments are. You have to be self-reliant because there is no one that you can complain to and who will set things right. And so investors looking for advice from their financial advisors or intermediary services, they often find that they can't get this advice from their financial advisors. And the reason being, from the advisor's point of view, even if they have a desire to allocate some of their clients' money or portfolios into crypto assets, even if their client is in fact demanding it, which is often the case for advisors, their clients want exposure, there isn't a licensed category under phase yet. There may yet be. And so for advisors, they don't know what risk they're taking on because there is no licensed category to do this. And furthermore, where the customer doesn't necessarily have the infrastructure or know-how to take custody of these private keys, the advisor doesn't want to do it either and take on that risk. And this results in many people who it might be appropriate for them to invest into cryptocurrencies being excluded from this innovative asset class. Now, even companies and financial institutions are encountering difficulties with getting into this space. By financial institutions, I mean pension funds or fund managers. As we described before, it takes a different set of execution skills that they don't necessarily have. Secondly, private key management is not something that they have systems and processes for. For example, a company can't just give the private key that's holding millions of rands of value potentially to their CFO. That would entail too much risk. Companies and institutions also have authority frameworks. What this means is that, for example, to release a payment, they often need two people to release a payment. And then if the amount is a bit larger, it requires a manager sign-off. If it's even larger, it requires the board's approval. For example, again, cryptocurrencies don't necessarily fit in with the frameworks and systems and processes they already have in place. Furthermore, often the financial institutions that help the corporates, they have ways of preventing fraud. If a signature looks funny, they check it further. If a payment is of an unusually large amount, they may call up the finance department and check. And there are various flags they may raise to help prevent fraud. And finally, companies and institutions don't necessarily have a way of valuing these investments, which they need to do in order to account for it and ultimately to report to investors. Now, it is possible to build out all these systems and processes. MicroStrategy did it, and they published all of the information of how they did this. And it's now open source and available for everyone. But most of these companies and financial institutions find that they are just trying to do the best of what they already do, which may be manufacturing something or selling a service, and they don't necessarily have the capacity or expertise to build this all up in-house. So in the crypto space, there are numerous great products enabled by this amazing technology. However, what most people find when they first start interacting with it is that the user interface is very difficult to understand and difficult to use. Furthermore, as we described, the crypto products don't necessarily plug into the systems and processes of the traditional companies and institutions. And getting there, like MicroStrategy did, has a huge time demand, either on individuals, unless their job is to be in the crypto space, or on companies and institutions. And so what many investors are finding is that there is a need for some kind of traditional interface that they're used to dealing with, but to access the crypto asset class. Now, Jaltech's answer to this are Jaltech's cryptocurrency notes. Jaltech has created 3 different notes. One note provides 100% exposure to Bitcoin. The other note provides 100% exposure to Ether. And there's a third note that provides exposure to a diversified index of cryptocurrencies and tokens for people who are looking for diversification. Investors can go into one or a combination of the 3 notes. To give you an example of how it works, let's take the Bitcoin note. Today, if someone invests 100,000 Rand into the Bitcoin note, and then Bitcoin itself goes up by 50% in value, and they then want to redeem the note or cash it in, that note or investment will be worth 150,000 Rand, less any applicable fees. And investors' ability to cash these in is 1-day liquidity, meaning that during business hours, meaning that they want to cash in the note on a Wednesday, then on a Thursday, they will receive the proceeds. The minimum investment size is going to be 10,000 Rand per investor, and that's once the offer is open, which is expected to be later this month. And what we have done behind the scenes is we've got this interface that people are used to dealing with. And behind the scenes, we have all the systems and processes. We have the professional execution capability to buy the cryptocurrencies at optimal prices. And we have institutional grade custody to keep the cryptocurrencies safe while we hold them. Now, I want to talk about the Jaltech Large Cap Index, which is the diversified note. How the index is made up of the largest coins and tokens by market capitalization. What we then do is we remove the stable coins. Stable coins are coins that are trying to track a certain value. Often it's the US dollar. And so there's no scope for that price to go up. Hence, we remove those out of the index. We also then apply historical metrics and security metrics. So as we know, cryptocurrencies are very volatile, and a cryptocurrency's value might skyrocket upwards, and then all of a sudden the next day drop aggressively as well. And in order to prevent that coin getting into our index and then dropping out, what we do is we make sure that the coins have a certain minimum history of market capitalization over a period of time, trading volumes over a period of time, and liquidity over a period of time. Secondly, we then impose security metrics. So we disqualify any coin that is too centralized, which means that people could change values. We also disqualify any coins that have any known security issues, and we remove those. Finally, we employ a minimum diversification. How we do this is by capping the size of any one coin in the index. So once we've removed all the coins that are disqualified, Bitcoin would end up being 65% of the index and Ether most of the rest. So it wouldn't really serve the purpose of giving people diversification. So what we've done is we've capped the Bitcoin at 30%, we've capped Ether at 30%, and then the rest of the coins did not need to be capped inside the index. The index is currently made up of, by size, Bitcoin, Ether, then Binance, then Cardano, Polkadot, Uniswap, Chainlink, and the smallest allocation, that thin light blue sliver, is Aave. We rebalance the index quarterly, or if there are very large moves and the index now does not reflect the market capitalization. Finally, we rebalance the index if there's an emergency. If a new security exploit has been discovered or some problem has been uncovered, we then rebalance the index more frequently. Now onto the most important slide, the regulations. So since FaZe doesn't yet cater for crypto products, and FaZe is the set of regulations that governs financial products, what we've done is the company issuing these notes is a public company. And the issue of the notes is a public offer with a SIPC approved prospectus. What this does for investors is it forces on the company higher levels of transparency and accountability. There are minimum standards of auditing, of governance, of disclosures of information, etc. Secondly, our governance framework is that we have an independent controlled board, keeping the company to the highest levels of governance, focused on investor interests first. Probably most importantly is that by creating these notes are classified as a debenture, which is just unsecured debt. The advantage of doing this is that debenture is something that the FaZe regulated sales channel can sell. We have a legal opinion that FaZe regulated advisors who are either licensed under the category securities and investments or the subcategory debentures can now sell this product. And this puts advisors in a place where they can have peace of mind selling this product. For investors, this allows them to get advice, have someone else who's a professional do the research for them, and then even provide the intermediary services. Now, advisors would be well advised to have a working knowledge of the underlying cryptocurrencies. This is the ultimate exposure the investors are getting, whether it's Bitcoin, Ether, or the diversified index. Now, many people may object to the usefulness of these notes, citing either going direct as an option or that this dilutes the proposition of cryptocurrencies, as people now have to trust Jaltech instead of the environment being trustless. So what we've done is we've compared going direct to the Jaltech notes and the benefits of coming via Jaltech. Firstly, the Jaltech notes offers optimal execution, which going direct, an investor may not have the skill set. Secondly, the Jaltech note is much more convenient to use because We have invested in the systems and processes. We've invested in the trading capability and in the institutional grade security, which is the next point. Nextly, the estate planning. The Jaltech notes fit quite conveniently into the normal estate planning framework. These notes can go into the estate if someone was to die and be inherited safely by the heirs without any requisite skills on their part. Finally, it's regulated via the public offer and via the sales channel. And finally, with the Jaltech Large Cap Index note, it comes with prepackaged diversification, resulting in know-how, peace of mind, and ease of use for investors. Now, there are many arguments that you would have heard today for investing in cryptocurrencies, and there are also many arguments that people put forward against investing in cryptocurrencies. People talk about the nature of money and how cryptocurrencies is a more sound form of money. People talk about the amazing technology. On the other hand, people talk about the illicit transactions that cryptocurrencies may facilitate and that regulators may ban them. However, there's one argument which does not involve knowing the future, because all of those arguments are uncertain given the future. And so whether you believe or disbelieve any of those arguments, this argument is irrefutable. And that is that cryptocurrencies have an asymmetric payoff profile. What this means is that if you invest an amount, let's say 100 Rand, the maximum loss can only be what you invested, that 100 Rand. However, the maximum gain can be very, very high indeed. That could end up being worth 2,000 Rand or 5,000 Rand or 10,000 Rand. And so your gain is much more than the potential 100 Rand you stand to lose. A numerical example is here. We compare a portfolio that has no crypto exposure in it. And over a 4-year period, it grows to 146 Rand. However, when comparing this with the portfolio that has invested 2% into crypto assets, and for some reason, the worst happens, the maximum loss happens, and that 2% goes to zero. After 4 years, the 146 Rand is only slightly less, it's 143 Rand. However, if the positive event happens, the crypto assets do a 20 times gain over the 4 years, which has done far more than in recent history. That 100 Rand portfolio becomes 185 Rand. And it ends up growing to more than 40% of the original portfolio. Thank you very much. If you are interested in the product, have any further questions, please reach out to us at info@jaltech.co.za.